This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. Today, we dive into the surprising uptick in consumer confidence and what it could mean for short-term spending, and why that optimism might be short-lived. From Manpower Group's dividend cut to rising delinquency rates and early signs of stress in the housing market, we explore the growing disconnect between consumer sentiment and economic reality. David, I do want to get to what's going on with the Manpower Group, but first, you alerted the team to this CNBC headline: Consumer confidence for May was much stronger than expected on optimism for trade deals. We referenced the Consumer Confidence Index numerous times over the course of a year. Do you think, is the index reflecting reality here?
Well, it does, because it confidence is up, you'll spend more money, right? And our economy is consumer driven. So, and why is it up? Well, even though the stock market is not the economy, right? When the stock market rebounds like it did, confidence exudes around, right? Your 401k balance went back up. You were a little nervous maybe a month ago. We had people in questioners, right? True. When it rebounds like it did, a quick rebound, all of a sudden people get confident. And of course, there's been talk of trade deals, lots of talk of trade deals. We don't really have deals, but that optimism is what refueled the rebound in the markets. And then, so that also is playing out in consumer confidence. So yes, consumer confidence is up. And that means, and just so you understand, that means the next 4 to 6 weeks, consumers will continue to spend as they have spent. So that's a good sign in the short term. Softening job market would take us potentially the other way, and that's the Manpower story that you had mentioned earlier that we were talking about. So, well,
let's go there next. And you alerted the team to this. Manpower Group just cut dividend by 53%. When the world's largest staffing firm is pulling back cash, you should probably pay attention. You've got other stats and observations here. What's going on here? As I said, well, the job numbers have been great the last couple of months. Why is Manpower so nervous?
So they're basically about the largest staffing company out there. So, right. Staffing companies are helpful for companies that are growing and you can't quite hire fast enough. And so you reach out to a staffing company, they can find you temporary employment, and many of these jobs become temporary. We've hired people from staffing companies that we roll them into full-time employment after our contract with the staffing company is up. So they help place potential candidates into jobs, et cetera. They charge a margin on the wage you are paying the person. So that's how they make money. Well, they are forecasting pretty rough times ahead. They cut their dividend in half. And I mean, that is not an insignificant move, and that's telling you they see significantly less revenue in the near term or coming 6 to 18 months or so. So as we've been talking about, we see a softening, a very, very aggressive softening in the job market. We've not gotten into net job losses yet, right? We still are creating jobs. But those numbers, I mean, just a month ago, we had 127,000 jobs created for the month. That was a pretty low number. As we've talked about for years, you want to stay at 250,000 or above to keep the economy growing, and that takes care of birth debt rates, et cetera. But we are not doing that. And, of course, we had all the information come out from the government. Oh, those 800,000 jobs during the previous administration, we made those up, right? So the job market is nowhere near as strong as it was kind of touted, and that's a leading indicator of where the economy is going, because if people lose their jobs, and we're seeing that pick up, as I said, you're not going to see job losses really mount until the back half of this year, because the higher interest rates and yields have been spiking. That's higher cost of capital for corporations, which means they can't borrow money to expand, which means they are not going to be hiring new employees, et cetera, et cetera. And it just rolls. So again, short-term confidence is up. That's the market rebound and the trade talk. If trade deals don't get done, or if this spending bill adds to our deficit and yields keep ripping higher, that's going to crush consumer confidence in the long run. And it's also going to crush one of the most critical components of our economy, Chip, the housing sector. And if the housing sector is not doing well, the economy's probably not doing well.
Well, we have something on that, too, coming up. Boy, the laws of economics, they're just as binding as the physical laws. They're just like the law of gravity in the physical world.
Breadcrumbs, right? Yeah, but we have editorializing people on the news. We don't have people that actually do fact checking anymore and actually just tell you what's going on. So hopefully you find this show is a nice place to find some of this information.
David, you mentioned that, let's see, how did you phrase it? Confidence fuels consumerism. Confidence, people buy if they're feeling good and they're feeling confident about where the market's going, where the country's going economically and financially. Well, now, you almost have to be a psychologist to be an economist these days. You sent the team some information on delinquency versus consumption. We are a consumption-driven economy. And what stood out to you?
Well, we have a lot of folks that are falling behind on their bills. So auto loans are at serious delinquency rates. We're now seeing subprime mortgage borrowers at very, very high serious delinquency rates, credit card delinquency rates. So all the factors, right? Mortgage debt, that's the one that you really want to pay attention to, because most people, they may not pay a credit card bill in the short run. They get in trouble and then go a couple of months and try and catch back up. But you pay your housing, right? This is where you live. You do not, the fear of foreclosure is a very real motivator. So people typically will pay that bill first and foremost before any other. And we're starting to see delinquencies in mortgages start to creep up. And again, it makes a lot of sense. People bought houses that were maybe a little out of their reach under at least traditional metrics, Chip, over the last couple of years. We saw housing take off, right? But now interest rates have creeped up. So if you bought your house, and about half the mortgages are over 4% now that are out there, and so, which is really normalized rates, but that's a little bit higher. And people thought, well, I'll just go and pull the trigger now because I'll refinance in a year when rates go down. Well, rates didn't go down. So now they're paying that interest, and all of a sudden now their tax assessment, because the property assessed higher, they have a much bigger tax bill. Oh, and by the way, homeowners insurance in the last 5 years has gone up over 53% nationwide average, right? And your auto insurance goes. So all these bills are rolling up, but your wages aren't keeping up with that. In fact, we're starting to see wage inflation really roll the other way. So all these point to, all right, at some point the consumer is going to say, no mas, I can't do anymore. On top of that, I only have the story this week, student loan defaults are now being reported to the credit agencies again. So all these people that had these forbearances for the last 4 years and weren't paying a dime, well, now you're going to get dinged on your credit report for it, and therefore it's going to make you have to pay even higher interest rate for anything you do try to finance or refinance. Not good news.
It gives me the 2008 shivers when I see data like this. And
when you look at certain parts of the housing market, that's very true. So I sent you a listing in Florida, right?
Help me out, David. The protagonist in The Big Short, in the movie, I can't remember his name.
Steve Carroll played him, but yeah.
Steve Carroll played him. I can see Steve Carroll in my mind's eye, but I can't remember the guy's name. Real feisty, cantankerous guy, wasn't accepting conventional wisdom. Didn't he go down to Florida and start actually knocking on doors and checking on the housing market in Florida? And what he saw, the collapse beginning to happen in Florida, wasn't that kind of ground zero for what became the 2008 crisis?
Yeah, we saw pockets in Florida had a very, very, very big retraction in prices. Phoenix, Arizona, and parts of California had really significant drawdowns. So in other words, now we've seen during the pandemic, people move to the southern states a lot, right? Better weather, et cetera. And in particular, some of the tax-free states, right? And liberty states, if you will. So we had Texas, Florida, Tennessee, South Carolina, and Arizona. People moved to those states at very aggressive rates over the last 5 to 6 years. Well, that creates a demand, right, for the housing. So the housing prices just kept going up, and people had all the stimulus money, so they could pay it. And interest rates were artificially low. So, all right, even though it's 50 grand more than I thought I'd spend on a house, the mortgage is cheap. So they bought these houses. Well, now, just what I talked about, finding out what it costs to maintain that house, the housing insurance, the taxes, et cetera, the maintenance on that house is increasing exponentially. So even with the low interest rate locked in, a lot of people are finding they can't afford the houses, so now they're having to sell them, and we're seeing listings shot through the roof. We just covered on the show, I think it was 2 weeks ago, the amount of listings in the state of Florida alone is greater than all the listings in the top 10 New England states,
the
whole quadrant of the Northeast
New
of the
England
United
and
States.
the Northeast into New York and Pennsylvania. And,
that is an amazing stat. So I gave an example, and I do, and I own, full disclosure, I own property. I own property in Florida. I own rental property in Florida. And the property, and literally I have a realtor down there that sends me an update on my properties every month, right? And gave me market softening was how he kind of put it. I'm like, so read the example there, the listing price.
August 29th, 2023, listed at $317,860. Same home still on the market in May of this year, and the listing has dropped to $265,000.
That's about a 25% drop in the price of the house, right? And still not sold.
Yeah.
So I sent a statistic out to the team this morning, actually. I don't know if you got that in time for the show, but it showed a chart where the price of housing long term versus mortgage rates long term. We go back, I think the chart goes back like 50 years, and mortgage rates are literally, the 30-year mortgage rate is within 25 basis points of its 50-year average at about 6.79%. That's a 50-year average of a 30-year mortgage. Housing is 90% above its 50-year average in pricing. And so I simply said one of these two has to adjust, right? Because if we had 1% mortgages, you could justify the price of the houses being up where they are. But if we don't, something has to correct, and everything reverts to the mean. Again, we just look at data and math. We don't speculate, but something is going to break. So either interest rates are going to drop aggressively or housing prices are going to drop aggressively. And again, Zillow, one of the industry barometers watching real estate, has forecasting a negative price watch nationwide for real estate. And I told you on this show, we're expecting 7 to 9% reduction nationwide in real estate prices over the next 12 to 18 months. Now, every place will be different, and don't think that means anything. If it's your home and you're staying in it for the next 7 or 10 years, don't worry about it, right? It's long-term shelter. But if this is something you have to sell, well, that puts you in a quandary. You have to decide, do I want to sell for less? And again, we have not had that capitulation where sellers have said, all right, I'm just going to drop the price to sell it. But that's probably coming, especially in markets that were really hot for a while, Texas, Arizona, Florida, et cetera.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.